Hey everybody, I'm Quint, and today we're going to talk about Roth IRAs and the power of these types of accounts. Now, you might be familiar with the Roth. The Roth IRA is an investment account or an account that acts as a retirement account, with the caveat being that money that goes into this account is already been taxed. It's already been taxed. So you get money from your paycheck, goes into your bank account, and if you qualify, because there's some income thresholds, you can make a contribution to a Roth IRA. You don't get a tax deduction. Oh, that stinks. Except the minute that money goes into the Roth, it is never taxed again. And oh, by the way, this is a big deal. When you become 72, which I know for many people that's like a million years away, but at age 72, there is also what we call no required minimum distribution. So the government doesn't make you take the money out of the Roth. Now, what is so amazing about these type of accounts is most people are well aware that you can contribute to the Roth. But did you know that you can convert money to a Roth? That's right. You can put money in through a contribution. You can also put money in through a conversion. Now, what is a conversion? A conversion is taking money out of an IRA, converting it to a Roth, and when you do, you pay the taxes at that moment. Now, why would you do that? Why would that make sense? Because again, when you convert, you never pay taxes again. And oh, by the way, RMD, no RMD. So it's very important to understand, before we talk about this strategy, contribution, conversion. Why are we talking about this today? Because the conversion is one of the most underutilized, best financial planning tools that are out there today, especially if you are concerned about rising tax rates in the future and how that's going to impact your income tax. Let's take a look at a broad scenario here of an individual who is working and paying regular federal income tax and maybe some other taxes as well, capital gains, what have you, and ultimately during their working years finds themselves in a pretty significant tax bracket. Now, this happens to so many people instinctually when they retire and they want to delay taking money out of their retirement accounts. So for the first several years, they live off of maybe Social Security and savings. And that's great until they have to start taking a required minimum distribution. And when they have to start taking a required minimum distribution, that money comes out and ultimately is taxed as ordinary income. But what about this period here? This magical period of low tax bracket. Well, what could you do? What if instead of just living off of the savings that you have and Social Security, you decided to take advantage of that time period and start doing Roth conversion? Let's say that you found yourself in a 0% or maybe to a 10% bracket during those periods, and you then had the ability to take money out of your IRA, convert it to your Roth IRA, pay the tax at 10%, and never pay tax again. There's another caveat. No, it's not just the RMD. I knew you thought I was going there. Yes, that is important because now once it's in there, it's not subject to the RMD. But guess what else? When they changed the law to 72 for the RMD, they also threw in this caveat. The caveat is as follows. Your children who might inherit this IRA have to take it out in 10 years, 100% out in 10 years. It's 100% income taxable to them as well at their brackets. One way to get around this is money in a Roth still has to be taken out, no taxes. It may not be right for everyone, But if you're not exploring this Roth conversion option as you proceed towards or in retirement, you could be missing out on a huge, huge strategy that could save you significant tax dollars. Take care.